I got a special treat for you. Joining us is a special guest from the United States. He is the author of How to Invest in Gold and Silver, one of the very few books that guide people into valuing and investing in gold and silver mining companies. He also owns the website goldstockdata.com. This website is a go-to for professional and retail investors interested in gold stocks. Now, back in 2013 to 2014, in that severe gold bear market, I frequented this website, learned a lot from his work, and it allowed me to stand my ground until the bull market came in 2015. This website and what his works and insights are did a lot for my family and also with my friends. It is my honor to introduce to you a trailblazer of the gold community, Don Durette.
Hey, Brian, thanks for having me on.
And thanks for joining us. Now, Don, can you tell us a bit about how you got into gold, investing in gold stocks? And how did you develop the valuation methodology for which many in the mining investment space hold you in high regard?
Yeah, it's two separate questions, but I'll answer them both. So it's kind of odd how I got into gold and silver. I read a book in 1989. I was 29 at the time, to give you an idea. And it was a book that it was called Conversations with Nostradamus. And this lady, Dolores Cannon, she claimed that she had connected with Nostradamus while he was alive. So it was a 3-book series. And it was basically just this interview with Nostradamus while he was alive, which is really bizarre.
That's like 400, 500 years ago.
Yeah. She crossed time. It was really, really odd. So in that book, Nostradamus claims that the U.S. was entering its sunset period and that it was going to lose its global dominance. Well, here we are 30 years later, and it hasn't happened yet. But we're on the precipice of it. But when he said that the U.S. was going to lose its global dominance, the one thing that resonated with me at the time, so I actually had just finished my MBA, so I was really, kind of focused on finance to a certain degree. I went into IT, but I did just finished my MBA. So the one thing that resonated with me was that if the U.S. was going to lose its economic dominance, that means the dollar was in trouble. So I wasn't going to invest in stocks. So what would work? What was the one thing that was going to do well? And for me, the one thing I thought would do well would be gold. Because if the dollar goes down, gold will go up. It's 30 years down the road. So I started investing in mutual funds in 1990, like a year after I read that book. Turned out that it was a bad thing to do because the 90s were kind of a rocket ship for tech.
Yes, it was.
But that original investment actually paid off very well. For instance, the cost basis of that original investment is negative. So because of the dividends, they've all paid off. And I still own the mutual fund. But then in 2004, I hit my objective. So I wanted 5,000 shares of this mutual fund. So I hit it. And I decided I was going to invest in something else. I was running, a jog with a friend of mine. And I was telling him about, what I was going to do next, gold mutual funds. I told him I was going to try to invest in juniors. And then he told me he was going to invest in silver. Okay. And so I'd never even thought of investing in silver. This was 2004. So I went and looked for a silver mutual fund because at that time I was investing in gold mutual funds. There was none. There was no gold silver mutual funds. So if I was going to invest in silver miners, I had to learn how to do it. So starting in 2004, I started buying junior miners, both gold and silver, and I started learning how to do it on my own. There was no books. There was 0 books out there. That's why I wrote my book, How to Invest in Gold and Silver, the focus on mining stocks. So I wrote the book first, and then I wrote the book 6 years after, so 2010. So it took me 6 years to learn how to do it. And then I wrote the book because I'm a writer and there was no books out there. So the book is basically a textbook. It's a how-to. And then I created my website because there was no websites out there that had good data on mining stocks. So gold stock data is really gold silver stock data because it's both. So I created them both out of need. So it's created by a miner, an investor. Okay, that's how I started. Yeah. Now, my methodology on valuation. So there's two different types of ways to value for me. For one, for instance, is exploration companies. Exploration companies are difficult to value, very difficult. So the way that I value them is they're gold in the ground in tandem with the location and in tandem with how much it's been de-risked. So the more that it's de-risked, the higher the gold in the ground or the silver in the ground is going to be valued. So initially, if all the company's doing is drilling, it's all they're doing, they haven't done any de-risking, and it's in a good location, then you have to start looking at grade. And then the grade really will give you a pretty good idea of its economic value. And then that's it's like an art. That gives you a kind of a starting point. So you start thinking in terms, I like to use kind of a base number of $100 an ounce. That's kind of a baseline, right? But then it'll be worth less if it hasn't been de-risked, and it'll be worth less if it's not in a good location. It's pretty rare for a company that has gold in the ground to be worth, say, more than $150 an ounce. It's just that doesn't happen. So 150 is about as high as it will go. And so you can do that. You can basically try. It takes a little bit of time, but you can start to get a kind of a feel for what an exploration company is going to be worth if they sell the company. Yeah. So that's exploration plays. So then you have development and producers. For those, I like to focus on estimating future cash flow. And I estimate future cash flow based on what I think they're going to, how many ounces they're going to mine. So I estimate their future reserves. And then from their future reserves, I use an estimated future gold price. So like right now, I use $2,500 gold. Yeah. So then you take that and then you estimate their cost. Those are the only three numbers that I use. Well, then I also use the tax rate as well. Yeah. Because that's going to limit their profitability. It's going to limit their free cash flow. So you estimate their annual free cash flow, and then I'll put a multiple on it. And the multiple is going to be a minimum of 5. 5 is a very conservative number. So I'll use 5 for a lot of times because the CapEx might be high. So they're going to have to fund that CapEx. So it's going to limit their upside. So I'll use like 5. That's kind of a minimum. Then I'll go up to like 8 or 10 or 15, depending on location, CapEx, how much their balance sheet, how strong it is. But the average for me is about 10. Yeah. So I use about a 10 multiple, and I'll estimate their future cash flow. Then I'll compare that. That'll allow me to estimate their future market cap, right? You take all that free cash flow and you put the multiple on it, and that'll give you a future market cap. Then you compare the future market cap to the current market cap, and that'll show you your upside potential. And so that's how I do it. And I'm looking for a minimum of a 3-bagger. Yeah. Because in gold and silver, I want to have significant upside. There's just too much risk involved. So if it's not at least a 3-bagger, I'm not interested. So if there's a company that I like and it's a 2-bagger, I'll be very patient and I'll wait until it's a 3 or a 4-bagger before I'll buy it. I don't want to buy a pricey stock. So that's kind of my valuation methods. And there's a couple others that people use. For instance, they use their resources, and they'll compare the resource per ounce versus the market cap. People will do that a lot, but I'm a cash flow guy. I really like to use the cash flow. To me, that is because I really feel that cash flow is going to increase in value as the price of gold goes up. So that if you can see that a company is a producer today, that we can pretty much know that future cash flow is going to be worth more money as the price of gold goes up. So it's a good way to analyze companies if you believe in higher gold and silver prices.
That's a really detailed response to the question, Don. And in fact, I have to say, when you said that you actually started investing in gold back in or gold mutual funds back in 1990, if people actually look at what happened with the price of gold from 1990 to 2003, it will have looked like nothing really happened. But then this is where gold stocks and gold actually decouple, because people think that, well, nothing's happening with gold, so therefore it's not a profitable investment. But with gold mining companies, they go through cycles, and it is actually investing through those different cycles, getting in at the right time and sticking around even during the difficult times that I believe, Don, you probably made your fortunes, or at least you made enough to be confident that people are going to read the book that you have and go to your website. And I'm actually, I recommended your book to quite a number of my friends and also subscribers in Gold Stock Pro and Jim Rickards Strategic Intelligence, because it makes a lot of sense. You say that your book is a textbook, but honestly, textbooks are different from your book, because your book is not designed to make you sound smart. It's actually to make them, it's to make the reader feel smart, and they can actually do it. Because I teach in university, I read textbooks and I go, now these people make themselves sound really smart. The student themselves are actually climbing up a really steep cliff. In your case, it was very accessible. And in terms of like you also talked about how you valued explorers using resources and looking at cash flow. This leads to my next question. So there are different ways to value producers, developers, and explorers. What is it that which of the three do you like in particular? Which of the three are your favorites? And what are the features that you look for and that makes you feel that you prefer one over the others?
Yeah, I'll start off by saying that my book goes into detail on all of the factors. There's a separate chapter for majors, mid-tiers, and juniors. And so for each of those individual categories, and then the juniors are I have 6 different categories within juniors. And it goes into detail on what to look for on each of the categories, all the little pieces in the puzzle that you need to understand. And so I prefer producers, because I'm in this. The whole purpose that I'm in this is for a once in a lifetime, once in a generation gold bull market. This isn't something, these commodity cycles are very rare. They happen like once a lifetime, maybe twice, but gold, it's had 2 short runs, 1980 and then 2011. And in 1980, we got to 850, I think, on gold. And then it only lasted a couple months. Same thing happened in 2011. We got to 1935, and it only lasted a couple months. So we haven't had in our lifetime, a significant extended bull market. And I'm waiting for that. That's the whole purpose I'm doing this. And so when that comes, the one, in my opinion, the one category that you can be somewhat depend on is your producer, because your producer, their balance sheets are going to improve. And again, if it's an extended bull market, say if it lasts at least 2 years, they get 8 quarters of basically cash flow. Their balance sheets are going to improve dramatically. They're going to basically, and that balance sheet, and in tandem with that, their free cash flow multiple is going to increase. So for your mid-tier, a quality mid-tier is going to get a free cash multiple of about 10 today. And a major is going to get about 15 to 20, depending on the lower cost, stronger balance sheet. So they get better multiples. In my opinion, so you get kind of a double increase in value for a miner as the price of gold goes up. One is the multiple goes up because the risk level goes down.
Yeah.
As the risk level goes down and they have a stronger balance sheet, you're going to give it a higher valuation. It's like a PEs. The PE they go up whenever you get a strong market, right? Strong economy, stronger profits, higher PEs. You don't have to worry about PEs so much in miners. You can just focus on free cash flow. And because the price of gold is so important on the value of the company, that price of gold is going to impact their cash flow, the free cash flow. And free cash flow is just kind of another name for profit plus or profit. You have to actually add back to get free cash flow. So it's profit plus. It's not just profit. Because it's a cash business. They spend a lot of money, and they wouldn't have to spend that money if they're on a break-even basis. So I don't want to go into what you add back onto the profit for free cash flow. There's like 8 different data points. Yeah, it's in my book, though, of course. So producers, we can be somewhat depend upon the multiples going higher. So I think that the mid tiers are going to double from 10 to 20. And the majors are going to double from 15 to 25 to 30. So we're going to get these really high multiples. So that valuation, so basically the companies today are valued at like 50% of what they're going to be valued at. Right at the stop, you have that. But in tandem with that, they get valued on how much cash flow they have. So as their cash flow goes up, they're going to get valued on that at the higher multiple. So it's almost an exponential growth that you can somewhat depend on. So it's a very powerful way to project valuations based on future gold, silver prices. If I'm right, the valuations of these companies are just going to totally explode. For instance, if you take the price of silver, currently it's under $20. If the price of silver goes up 5x or 4x to 100, the valuations of these companies, the leverage is so significant that we don't know how valuable they're going to get. But in theory, the valuations could be historic, epic even. And I always tell people just the run, if you look at the silver chart from, say, the historical monthly silver chart going back to 1970, for instance, you have these huge this huge cup, say from 1980 all the way down till 2011. We had that huge cup. And then from 2011 until now, you had another cup because we had a 10-year correction. So that could be considered the handle. So it's like a massive cup and handle. That technically is really set up for silver to go to $100. And I think $100 silver is definitely something. I actually don't think that people should even be buying silver stocks unless they're confident that silver is going to at least go to 50 and potentially go to 75 to 100. Because the risk is so high, you have to have confidence, really. And I'm very confident that it's $100 silver is a possibility. And so the leverage on these miners is fairly stunning. And gold is the same. Some people think that gold is going to go above $5,000. So I mentioned $100 silver. For me, I look at it as gold going to $3,000 to $3,500. So let's say it goes to 3,000 to 3,500. If we take a multiple of 30, which in 2011, the GSR multiple, gold silver ratio, went down to 39. And so if we look at it going down to 30, that would take silver, that makes silver go to $100. So if you take 3,000 divided by 30, it goes to 100. And if it goes to 3,500, in theory, it could go even higher than 100. So the 30 multiple, I don't think is really crazy. So that's the reason why I like the producers. I'm overweight producers. I really feel that that's really where you want to put your heavier weight. The developers and your explorers, the risk level just increases dramatically. I talk about it in my book. It's like night and day difference. And we can talk a little bit of reason about why the risk is so high on those two categories.
Yeah, there's actually quite a lot to unpack from your response just then that I wanted to comment on this. When I got into gold stocks in mid 2013, and I stumbled upon your website, it was actually your website and Toccoa de Silva's bull market thinking that convinced me. Start off with producers, and during that time, luckily, producers were basically trading at a fraction of what it is now, even though we've had this massive sell-off in the last 3 months. And I waited till 2015, 2016, and actually made 10, 20 baggers on some of the mid-tier producers, which also I got off you and Toccoa. That was a place to actually build your wealth. Then once you get once you have gotten confident and you've got some capital to risk, then you start becoming more adventurous and going into developers and the explorers, because they are in a way kind of like playing roulette and picking numbers in roulette rather than picking colors or suits. So the other thing that you also said is you're looking at the price of gold being about $3,500 an ounce, which would equate to about 5,000 Australian dollars an ounce. When I looked at your website back in mid 2013 and listened to your presentation, which is still on YouTube, you were doing your estimates on $2,000 an ounce gold, which we actually hit in the last 2-3 years, in fact. And also, what I also thought was really interesting is you talked about how gold had its massive run in 1970s to 1980s, and then we had another massive run from about 2002 to 2011. And while gold fell from $1,900 an ounce in 2011 to as low as $1,050 an ounce in 2015, that was largely because of the strengthening US dollar. The US dollar hasn't actually weakened too much in the last 3 years, and gold has actually managed to stand its ground. And I plotted the US dollar index adjusted price for gold, which I consider the intrinsic price of gold. And gold is currently trading at literally record high levels, and we're about 30%, 40% higher in terms of what gold is really worth than what it was in 2011. And gold stocks have actually pulled back quite a lot. And basically coming off of what you said, it is about a patience game. You've got to be patient right now as things pull back, because we're probably setting up for an even bigger run, in which 2015 was probably just like 2002, and we're only halfway through this this gold run. I'd say perhaps we might be in the cycle that we saw in 2007, where gold actually hit $1,000 an ounce for the first time. How would you comment on where we are in terms of the gold, the price of gold in this bigger scheme of things of the gold cycle?
Yeah, that's a really big question, but I like the question. I answer it all the time. Yeah, so remember I mentioned earlier that I have an MBA, and so I've always been when I got into gold, I've always been focused on the macro side of gold. What drives gold? What's going to make it go higher? Are there factors in place to achieve my goals? And so I'm always, every day, I'm looking at all the macro factors that go into play there. Now, in my opinion, the U.S. economy is on borrowed time, because since the 1980s, we've been deindustrializing, moving to a service economy, and it's not working. And so it's forced us to use debt to maintain our standard of living. If it wasn't for all of the money printing, the $30 trillion in debt, and the Fed's additional $9 trillion, that's $39 trillion right there. If it wasn't for all that money printing, we'd be a third world nation, basically. So we've been propping ourselves up, but it's basically a Potemkin economy. It's not real. A service type economy will work to a certain extent. It won't generate enough wealth to pull everybody up. And so we have a combination of a service service type economy and a slash rentier economy, where the finance and the real estate and the monopolies in high tech, and then all your housing, people that own all the houses like BlackRock right now, I read today where they're basically accumulating $50 billion because they want to buy the dip in housing because they know that is an area that you can just make a fortune on. But it sucks. It sucks. It hurts the economy overall because the 1% are basically making all the money and the middle class is shrinking. So in my opinion, I'm giving you a quick overview of the reason why gold's going higher. But my opinion that the US dollar right now, it's 87% of global trade. And the euro dollar is being loaned out. People are making loans in dollars all over globally, so they're paying them back in dollars. So there's more dollars international than there are in US. But I just feel that the U.S. economy can no longer support, basically the ability for the Fed to print at will. And so at a certain point, and I think it's coming soon, we dug ourselves out of 9/11 in 2001, and then we dug ourselves out of the great financial crisis in 2008. And now here we are. Are we going to be able to dig ourselves out of this one? I don't think we are. I think we're going to turn Japanese, rely on MMT, and basically get stuck with no growth. And it's going to create a lot of negative impacts on our standard of living and growth and the economy. It's like this deindustrialization is basically going to come home to roost. And when it does, gold's going higher. And that's when we have this, once we get above 2000, I think that's going to be the run that I've been expecting for 30 years.
It is quite a long wait, I have to say.
It's a long wait, right? It's been a long wait, but, in between, I've written a lot of books. I have a side job, side thing. I've written about 15 books, and I've gotten involved in crypto. So I've had these side hobbies to keep me busy. My website's I've had it for 10 years, 2012 till now. It's 10-year anniversary. That actually this month in July.
Oh wow!
And so, I've enjoyed doing it. But during this 10-year period, I've been educating people. You said you read my book and enjoyed it and learned something. So I've been educating people, and I think it's worth it. It's been painful, but overall, I probably would do it again. The only thing I would do differently is I would have bought a lot less exploration and development stocks, because both of them on the whole have been, I think, negative. Not great experiences, especially in the developers, because so many developers have disappointed me because they've sold out. They use our money to build as the shareholder, and say our money to the shareholders. They use the shareholder money to de-risk and develop these projects. And then they get close to production and they sell them for a small pittance. And usually when they sell them, the shareholders are underwater because of all the dilution that was required to get it into production. So it's very disconcerting. I say that developers, only about 20% of the developers pay off big. So that's not a good, and explorers is only about 10%. So those are and those are not good odds. Whereas producers, I think, are about 50%. If you get a good entry price. Yeah. And you pick good stocks, but I think you can do 40, 50% on the producers and make money over the long term.
Yeah, actually, that leads me to the question that you're on explorers and developers is, I know that there's a lot of luck involved in selecting the right explorers and developers, and with developers, the success rate is low because they tend to build probably near the top of the market when they can get the finances. And as they build, that market, the gold market might actually act against them, causing them to just like exactly what's happening. The last year and a half, you've actually even in Australia, we've got quite a number of companies that are building mines for the first time, and they are hitting quite a lot of hiccups. And I know that in America, America and Canada, there's been a few stories. So for those who are stubborn and also willing to gamble, what advice would you give as to how to play it right with explorers and developers? What would you look for those who basically go, I want to take this risk and I'm willing to risk it all for that big potential gain?
Sure.
Yeah.
So let's start with explorers. So the one thing that you want to do is you want to make sure they have the goods. I go over this in the book. Don't invest in an exploration story just because the geologist says it's great geology and we're going to find something. Wait until they have something and they're drilling it out. You want a really good discovery hole. So, and online I have a YouTube video on how to analyze drill results. So for a gold, to give you an idea what's a good discovery hole for a gold, for instance, a good hole is gram per ton times the width or length, whatever you want to use. You want it to be at least 50 for a good hole. For an excellent hole, so that would be like 5 meters times 10 grams per ton, something like that. You want it to be at least 50. That's kind of the minimum. And anything below 50, it's like, that's not a good drill hole, right? Then 100 is, you're starting to get into the excellent area. So 100 to 200 is excellent. But that's not what you're looking for a discovery hole. You want it higher than 200. You want something what I call stellar. You want something that, because a guy did some research, and this was a few years ago, I learned about this. A guy did research and he found that the discovery hole correlated to the size of the eventual size of the mine. And so if you don't have a stellar, and it correlates, it's almost like every single time. So if you don't have a stellar discovery hole, you're not going to find a big mine. Yeah. So you want those stellar holes. And so when you get a stellar hole, you can start to get excited then they have a stellar hole. Or if they don't have a stellar hole, they have a lot of excellent holes, over 100. So you figure the stellar hole is coming. And that happens quite a bit. They have a whole bunch of excellent holes. But don't get too excited about good holes. Good holes are adding ounces. Those are adding ounces, but those aren't indicators of a big mine yet. You still have to have those excellent holes and stellar holes to go with all those good holes. So you're waiting patiently, and once you see a few of these good holes, then you can jump on board and you can chase the drill holes. But you want to remember, it's not easy to find a big mine, and you're not going to make any money on a small mine. For instance, if they find if it's a gold mine and they find $1 million ounces, that's only $100 million. $100 times 1 million is 100 million. 100 million, that's not enough. I mean, you have to get in at 20 cents to get a 5-bagger. If it goes from 20 cents to $1, for instance, or you got to get in at 20 million. I mean, you got to get in a market cap of 20 million to get a 5-bagger, or that's a 4-bagger actually. So, 1 million is not, that doesn't do it for you. You want it to be at least 2 million plus. Well, I'll tell you what, 2 million plus mines are hard to find. So you got to be very selective. You don't want to have a whole bunch of these exploration plays. I mean, maybe 10 at the most, 10 drill stories all over the world. I think basically 10 is about the most you really want to bet on, because that's all you're going to find. You got to get in early. Now, you have to decide how much money, how much upside you're looking at, because some of these drill stories, if you're going to get in at 100 million, 200 million, 300 million, right? That's kind of late to the game. You can still get there because there's some plays out there that still have a lot of upside still to go.
Yes.
And it's okay, but you just got to be selective on those. But ideally, the best ones, you get in around 50 million, right around 50, 20, 25, 75 in there, that range. You want to get in around there and then hope that these really good early drill holes, it turns into a $4 or $5 million ounce project. And sometimes they get huge, like DeGray. I mean, I thought DeGray was going to max out at 10 million, and now they're like, looks like they're going to be higher than that. So sometimes, they get huge. Wallbridge, I think Wallbridge is still growing in size, and they're like under 100 million, but Wallbridge is one of those ones that looks pretty interesting as a drill story. And some of these drill stories, they might not necessarily be exploration stocks. They could be development, but there's just a ton of drilling still to go. So they're kind of a quasi developer drill story. Like I think Osino really excites me. It's a development story, but it's also a drill story because I think Osino has a lot of targets. And so that one's interesting to me as growth. G2 Goldfields down in Guyana is an early drill story. I mean, they've had those excellent holes. You never know if they're going to pay off, but it looks pretty interesting as a drill story. Lion One's another development / drill story. It's deep drilling down deep. We don't know how big it's going to be, but it's kind of interesting. There's Gold Rock Silver in Nevada. That one looks like it's going to grow. Vizsla looks pretty interesting. It's growing out. So some of these, but you want to make sure they have the goods. Don't be chasing these stocks that don't have the goods. You don't want to be too late to the show. Like Snowline has been exploding in value, and I think it's gotten a little pricey. Yeah. We don't know how big Snowline's going to get, but Snowline, that one was kind of interesting early. A lot of people are going to make money on Snowline because of those early drill results kind of pointed to something. So that's when you want to jump in. The people that jumped in early on Snowline are probably going to make some money. We'll see how much bigger it gets. Teuton, that one's still growing in size. It's got like over 20 million ounces. It's still not super pricey. So, you can chase some of these ones that are a little mature, but it's better. I think the ideal ones. Then there's a few others. Like there was one recently that had 9 meters at 125 grams per ton. That's pretty impressive. It has a market cap of $10 million. It's called Polar X, I believe. 10 million. It didn't move. It didn't jump. Nobody, everybody ignored it. I forget where the location is. I don't think it's in a bad location though. But it didn't even move. Usually drill holes like that, those stocks go up double or triple in one day. So that's what you want to do. You want to basically go for the goods. Okay, so that was the exploration. What
the mine developers? What would you look for?
Okay. Now we're going to talk about developers, right? Okay, yeah. So developers are much more complex to analyze than your exploration plays. And in fact, they're probably more complex than a producer because the exploration play doesn't have any cash flow currently, so the risk is higher than a producer. It doesn't have a track record, right? So your management team doesn't have a track record. You don't know how good they're going to do. There's risk there. The location, if you're a producer, they're already up and producing, so you're kind of confident the location is not a big problem. You got permit issues. Are they going to be able to permit it? What's the CapEx? So for me, CapEx is always really important. So for CapEx, I like to have a starter mine of somewhere between 50 million and 150 million CapEx, because for me, that's easy to finance. And if you can start off at like 50,000 ounces a year or 80,000, maybe 100,000 ounces a year as your first mine, and then you have, 3 million plus in the ground. I like 3 million. 2 million is kind of a minimum. 1.5 is borderline for a developer. 1 million really doesn't get me excited unless they have exploration potential, because you're really looking at a small producer. So 1.5 is kind of like a minimum. Can they get to 1.5? 2 is like, you're starting to get there. Anything that's 3 million ounces or above, it starts to get exciting. So If you have a company that's got 3 million ounces and it looks like it's going to grow in size, and their starter mine is like somewhere around 100 million ounce capex, that starts to get me excited. That one looks really good. Then we want the growth. We want them to grow. So you don't make your money on the first mine, or you make it on the second one, or you don't make your money on phase one, you make it on phase two. So you have to think in terms of long-term, 3 to 5 years. Another thing for development is you want them to be in construction within 3 years. If it's going to take them longer than 3 years to get into construction, so you're looking at more than 4 years. Usually it's at least a 1 year build. Sometimes it's a 2 year build.
Yeah.
So you're looking at a 1 year build, that's 4 years out. That's kind of, I call those timeline issues. How long is it going to take before you get to see your money? So you're basically waiting. You're waiting for 4+ years. And during that period, they're not generating any money. So they're diluting their shares. And if nobody's buying the stock, it's languishing. So the risk is going up. Then grade comes into play, because grade is going to kind of determine the economics. Yeah. The other thing that's going to determine the economics is the capex. If it's a big capex issue, then even if you have decent, and then your cash cost. The cash cost is really important, and then your break-even cost. So for a gold mining company, I want the break-even for a developer, and the costs are going to go up because of inflation. I like it to be around 1,200 or less. And 1,300 is kind of borderline. I'll go for 13. But once you get to 1,400, 1,500, because inflation is going to kick in, you can usually pad that by at least $100, maybe $200. So if you get one of these development plays where it's like $1,500 break even, it's probably going to be $1,700 once they get into production. So that's when I'm not going to get real excited. So right around $1,200 or less, I get excited. It's like, okay, this one's going to be economic. This one looks really good. And then the grade comes in, of course, So let's talk a little bit about grade. So
yes.
So for an underground, an open pit mine, you want the grade to be at least 0.7, and 0.7 to 1 is like borderline, except for in a few places in the world, like Nevada, they can actually make money at 0.35, 0.4, but most places in the world can't make money at that. It's like 0.65, 0.7 is like the best they can do for making profit. So 0.7 is kind of borderline. You really want an open pit of being 1 gram or better, but sometimes they have offsets to go with it. Offsets are base metals, and so that can make it profitable at a little bit below 1. But at 1 gram, they usually can make money without any offsets. So you look for open pits. And an open pit of 1.2 to 1.5 is excellent, especially in a good location. Those can make a lot of money. So I look for those. So development and management team is really important. Have they done this before? Did they develop a project and then sell it? A lot of these companies, the CEO, he's like, he's a geologist or he's an accountant. You don't want that. You want the CEO to be an engineer, mining engineer, somebody who's done it before, and he doesn't want to sell. And he basically, that's another thing, is insiders. I like to see at least 25% insiders. If you get that, then they're not going to sell that easily, because the insiders want a good return. They don't want to give it away. They're like me. They want the 5-bagger. They don't want the 30% return. Yeah. So insiders to me is a real telltale sign if they're going to sell. So I like to see 25, 30, 35% insiders. That gives me some confidence they're going to hang on. How long it takes to permit a project, depending on the location. Sometimes they can permit in 2 years. The odd thing is that third world countries like Central South America and Africa, they actually can permit faster than, say, the U.S. or Canada. U.S. and Canada they're slowly getting longer and longer and longer. The U.S. is kind of becoming the worst place in the world to permit something. It's like takes 5 years. It's getting brutal. Alaska is getting brutal too, and now some places in Canada are getting longer. And so,
so the ESG issues, we're facing similar stuff in Australia as well, and New South Wales tends to be it's very slow.
There you go. Yeah, the location. So you want to look for mines that have been permitted in the area. That's nothing for development. Is it in a mining district? So if it's in a mining district, you can actually find out how long it took to permit these other mines. So that's really important. You just send an email to the company and say, okay, this company, how long is it going to take you to permit your mine? How long did it take them to permit their mine? They'll tell you, they'll answer your questions. And if they don't, then that's another one, interact with the company. And if they're not interacting back, that's a really bad sign.
Yeah.
I've had a lot of interaction with these companies. The ones that care about their retail tend to be the best executors. Basically, people that are really professional, they care about all the details across the board, right? They don't care about this and that. They care about everything. And so you'll know really fast. So they care about their retail customers. They care about their website, keeping their website up to date, stuff like that. The responses to people that interact with them. You can get a feel for the management team. That's important. Try to get a feel for them. And then the G&A, look at the G&A and see how much money they're spending on the quarterly basis. The ones that are, paying the big bucks, and in mining, it's unbelievable. The producers, a lot of the mid-tiers and above, the G&A is ridiculous. They're basically paying themselves. They're basically saying that we're special. This is a difficult industry, and we need to pay our CEO $5 million a year, $10 million a year. It's total baloney. They're just basically implying that it's a difficult industry, and so I deserve this money. They don't deserve it. It's that they got the board to pay them. They don't really care about the retail end. They're just, their G&A is way too high, and so. And the companies that care about the retail, they'll tell you outright, that we keep our salaries down, we keep our G&A down, because the G&A is basically, especially like in a development project, the G&A is going to suck the life out of it because they're going to have to raise money to pay that G&A every month. Yeah. And when I say G&A, I'm basically talking about salaries.
Yeah, there's not much else really, because the other than I would say equipment and diesel fuel costs, etc. But apart from that, it is about head office and paying the people on the ground. But yeah, the board is really the issue. Some of them are lifestyle companies.
Right.
Yeah. I'm just so glad to have you with us, because you provide so much information, and it's so educational. And just looking at the time, we're 50 minutes in, and I feel like we sat through 4 or 5 weeks of lectures in a university course. This is really good. I really appreciate it. Here's the last question. Most people look at gold stocks and the cyclical nature of gold stocks, and it tends to go up and down. And at stages like this, where we've just had the last 18 months, 2 years of false rallies and brutal sell-offs, are you an advocate of buying in and out, or are you one of those who sit there waiting very patiently until the company betrays your trust, and then you go, I'm out of that company and I'm not coming back unless there's something much better to bring me back in? Are you a camper, or are you a gorilla going in and out?
Yeah, so I'm definitely a camper, and the reason why is my personality. So I've been doing this for a long time. So junior since 2004, and mutual funds for almost 30 years. I've found that Jim Rogers always says that I'm a terrible market timer, and I feel the same way, because trying to pick bottoms, trying to pick tops. I've tried trying to pick, ups and downs, right? That's trading. And I've found that my personality doesn't fit that. I tried it a few times, especially with options, because with options, you're basically, trying to pick a short-term move up basically, or a short-term down if you're shorting. And so I tried a little bit with options, and I broke even, but it wasn't a good experience for me, because I found it was very, very difficult, and options trading is really hard. And so options trading and trading in general, you have to have a certain mentality to get in and out. And for me, my mentality is that am one of those guys that be right, sit tight. That's how my personality. I feel that I'm right about this company. I'm going to buy it. I'm going to hold it. I'm going to ride it until it hits my upside. So what I do, I'm like a camper. I basically consider myself more of a collector of stocks. So I basically just keep buying more and more and more, buy and hold, buy and hold. I do sell from time to time, but and I mainly sell out of disappointment from a company who basically, they basically changed their stripes, their story changed, something changed that I basically decided I don't want to own that anymore. Or if I have a 10 bagger and I feel like it's kind of ran its course and I don't think it's just going to keep running, then I will sell. So I sell 10 baggers from time to time. I sold, but sometimes I hold them. It depends. For instance, I sold the gray after it was a 10 bagger because I didn't think it was as big as it's going to get. And it was, it just exploded in value. And I decided, I don't think this thing has another 3-bagger in it. That would have been, I don't know. I forget what it was. It was at least a 10-bagger, but I didn't think it was going to be a 30, it would have been a 30 if it went up. So I decided to go ahead and sell. And there you go, trying to trade. I should have held it because I think the gray is a great stock, and I think it's going to go a lot higher. So once in a while, I will sell winners early to a certain extent. Now, losers, I tend to sell way too late on stocks that are going bankrupt. I always think they're going to turn around, and they don't. Arcana's a recent one that went bankrupt.
I fell for that too.
I should have sold it real early. Yeah, management really screwed that one up really bad. I thought it was a total slam dunk. I think the RV mine is going to be a big winner. Whoever buys it here, I'm a big fan of the mine, but they completely screwed it up. But what I do, I don't get hurt because I do not do large allocations. Because I know that a lot of these mines are going to go bankrupt, and I don't know which ones it's going to be. So I use low allocations, and I talk about this in my book, especially for higher risk stocks. So I won't do 1% of my cost base in what I consider a high risk. The only stocks that get 1% are quality producers. So the high risk stocks get 0.5 or 0.25. I get small allocations so I don't get hurt. That's how I do it. So when a company goes under, like Rio 2, it looks like they're going to go under, and then Arcana. So what I do is I replace them. So when a company goes under, I just go buy another stock. So I have like 2 stocks right now that I'm getting ready to buy to replace those 2. So that I've basically focused on. So whenever you have these cycles, whenever you have these down cycles, you want to make sure you buy the dip. Because that's usually where you get some of your best, returns. For instance, I've never owned Dundee, but I've always liked it, but it's always been pricey. It's never been a cheap stock. Well, right now, Dundee's gotten cheap enough for me. So that's the one I'm going to buy Dundee. That's the next one I'm going to buy. And then Regis. So these are both Australian companies.
Yep. That one had a really bad run the last 2.5 years.
Yes, absolutely. And Regis has been totally beat up. And so those are the 2 stocks I'm getting ready to buy. So I look I've never owned them. I own quite a few stocks. So when I say I don't own something, it's kind of unusual. So I haven't owned those because over the last 10 years, they haven't been cheap enough. And so I want at least a 3-bagger. So I've just kept my eye on them. They're basically in the background. If they ever get cheap enough, or we ever get a big enough sell-off, then I'll get a chance to own them. And then the other thing that I do during these big sell-offs is that I'll basically buy additional shares to lower my cost basis. And so stocks that have a high cost basis, I'll basically buy, some shares to lower my cost basis, and I feel like I'm getting some free shares. It's like those are shares I would have never owned because the only way I'm getting them now is because they've gotten cheap. So my style is to collect stocks and to buy dips as these corrections come. And to basically get my ducks in a row, so my portfolio is ready when this once in a lifetime bull market hits. But I want to actually finish here on my exit strategy, because it's a combination. My strategy is a combination of collecting stocks, selling some as they go up, selling some as they crash. But those are kind of rare events. I don't do it. I don't do it proactively. But what I do proactively is my exit strategy. My exit strategy is to sell to the top. And I talk about this in my book. If it's a once in a lifetime bull market, then we're going to get an opportunity to sell to the top. Now, what is selling to the top? For instance, silver. My first sell for silver is going to be $50 silver. So once we get to $50 silver, I have 45 silver miners, and I have some physical silver. So once we get to $50 silver, I will sell a couple silver stocks. Then when silver gets to 60, I'll look at my portfolio, and the ones that I'm going to sell are the best performers, not the worst ones, the best. So I'll sell the best performers, and I won't sell 100%, depending on the company. If I think that the company is going to keep going higher, I'll sell 80%, maybe 75, either 75 or 80, and then I'll do a trailing stop on it of about 20%. And I'll make it stop out on its own. So if it doesn't top out, so it's at 50 and I'm down 20% is like 40. So if it never gets to 40 and never sells out, then if it goes up to 60, my trailing stop goes up. See what I mean? Maybe it'll go to 45, then it goes to 75, it goes to 50. And I'm just going to keep the 20% trailing stop until it'll stop out on its own. Some of these stocks might not stop out for a long time, because we could have this mania and we just keep going up, 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 up. So that's the plan. And then every $10, I'll basically look at my portfolio and try to take some more. So once silver's at 80, 90, 100, I'll have a big chunk off the table. And the same with gold. So I won't sell any gold until $2,300 gold at the earliest, maybe not until $2,500. And then I'll start taking it off. And the plan is if gold gets to 3,000, I'll be out of 80% of my stocks. That's the plan. So that I've had this plan in place forever, and I'm still waiting. Maybe it'll never happen. Maybe I'll be waiting for 5 more years, but that's the plan.
Well, from what you're telling me, the fact that you're a gold and silver stock collector, and that you have what sounds like a very large portfolio. If producers, you're maxing at 1% of your portfolio, that's telling me, at least very clearly, that the last 30 years you've invested in gold stocks, you have actually done very well, even though we've had quite a number of serious ups and downs. So the fact that you've got a plan to sell down further when gold and silver rallies up, it's just telling me that during this time you've been doing very well. And even though the price of either of the two haven't reached your target yet, it is imminently happening, simply because gold and silver basically is like a ledger on how many screw-ups and stuff-ups that the central banks and the governments make. And it seems like they're accelerating the number of blunders that they make. So I believe it's definitely worth the wait. Don, I really appreciate you joining us for this interview. You have provided so much insights, and I know that we could actually chat for another 2 or 3 hours. We definitely want to have you back in the future, but in the interest of time, we'll probably leave it there. Thank you very, very much. And we hope that all the best with your investments. But Don, I'm going to just say thank you for joining us on the interview.
Sure.
For the viewers, I'm sure that they find this very, very valuable. And we definitely look forward to having you join us again.
All right. Thanks, Brian.
No problem.